With all of the layoffs that are going on right now and the mass firings, I thought it'd be a good idea to put together a video of 4 telltale signs that you're about to be fired. One of them could be that you work for the health department or any other government agency. All jokes aside, they're not the only ones losing jobs, guys. And to be fair, I'm not laughing at people losing jobs, just trying to inject a little bit of humor into such dark times, you know? Got to laugh a little bit in order to feel good about things. We talk about a lot of bad news on this channel, so it's good to lighten the mood a little bit. But the reason why you might want to look ahead to see if your job could be on the chopping block is because it gives you the first mover advantage. If you are aware that your employer might be cutting you off the roster pretty soon, then you can be out looking for a new job. You can be making plans and preparations for potentially losing that job. And if it doesn't happen, great. But if it does, you already have a plan B lined up. So one thing to look out for is a noticeable shift in attitude towards you from basically your boss or management, people who are in charge of running the operation, okay? Like for example, if you've always had a good rapport with your boss or the management at your work, and all of a sudden they start treating you different in ways that are like, you know, giving you the cold shoulder or not giving you that day off that you were hoping to get, or just having a standoff attitude in general, these could be key signs that you might be getting fired soon. They may also be giving you less favorable job assignments at work or less favorable tasks to complete, giving you fewer responsibilities, or transferring some of your tasks or responsibilities over to coworkers in preparation of firing you. Even a change in communication style can actually be a big red flag that you are about to get axed. Like for example, if communication always used to be your boss dropping by your desk to give you the latest update or assignment, and now you only get those updates through emails or the company newsletter or whatever, this can be a pretty obvious sign that something's wrong and you might be losing your job soon. The second thing is write-ups and reprimands. This is another warning sign because these disciplinary actions might be used as a base and actually create a paper trail that justifies your future termination. And the most obvious sign is not just that you are getting write-ups or reprimands, but that you are getting write-ups or reprimands for actions that other people are doing too, but for some reason they're just focusing on and picking on you. So getting unfavorable treatment all of a sudden, while everybody else, they just kind of turn the blind eye when they're 10, 15 minutes late, that can be a sign that you're next. The third thing is actually something that we've seen a lot happen with a lot of these big tech companies lately. Most notably, Meta has been using this to death. Negative performance reviews, okay? They give you negative feedback and performance reviews, and if the criticism seems overly done or exaggerated or fabricated, this is basically a tactic being used to get rid of you. And it's really important that you take a look at these performance reviews on yourself with a fine-tooth comb to make sure that they're not putting anything in there that actually isn't true or is completely overblown or embellished. Because if they're doing that and you have that in writing, that's proof that the company is basically trying to get rid of you for no good reason and can even be used in a future lawsuit. And that's what people are doing when they're unjustly fired, is they sue their employer a lot of times. Now, the fourth thing that they might do is put you on a performance improvement plan. They've already kind of told you, yeah, we're less than satisfied with your performance lately. These are the steps you're going to have to take to improve it, and you're going to have kind of a time window to correct your behavior, or else. And honestly, this is one of the biggest warning signs that you are likely going to be fired sooner than later, and they're most likely in preparation to be letting you go right now. So the problem with these performance improvement plans is they often contain difficult goals that are basically vague and hard to reach. So they're kind of giving you an impossible set of standards or new rules that they want you to follow, or unrealistic performance gains in order to keep your job. And you know, then that's going to be pretty much the last straw for you. And the real reason to put you on one of these performance plans or to give you a performance review is to just have negative documentation reputation against you. So that way, when they eventually do fire you, that it's justified in their book, and they can look at this and have a track record and say, well, see, this is why we let this person go, because they were doing X, Y, and Z, and we didn't do anything wrong. But I think it's crucial that any employees be on the lookout for these 4 signs right now, because with how many people are losing their jobs, you got to be extra careful. If you can just be ready for it before it happens to you, then you're going to be miles ahead of somebody who didn't see it coming. Here we have another flip, essentially. This house was sold back in 2022 for $980,000, and then it was just listed in March of 2025, a couple weeks ago, for $1.475 million. So 50% more this house is now worth in the span of 3 years. So let's see if they're going to get it. I don't know if I'm going to have a chance to walk by this house again before I leave for the summer, but there's a good chance it might still be available by the time I come back. Now let's be realistic. A lot of the reasons that people are losing jobs right now is because the American consumer is at a breaking point, okay? Consumer confidence is falling to its lowest levels that we've seen in many, many years. And that says a lot of things about how people are feeling and how they're spending their money right now, which ultimately impacts businesses. And what we saw from the Conference Board's Consumer Sentiment Index is that we are at the lowest reading in 12 years, which puts us right back during the time of the last major recession in this country. You know, consumer confidence is at 65.2 right now, and the baseline reading is 80. So anything under 80 typically signals a recession. That is far below 80. We're talking 15 points below 80. And people are scared about what's going to happen, especially with their job, because when you look further into the data on this, it proves it. Okay, there's a question in there that asks people how many jobs you think will be available, or do you think there'll be more jobs available in the future than there are now? And that reading decreased to 16.5%, whereas the month before it was 18.5%. So people are becoming increasingly less optimistic about the current state of the economy and the current job market. And basically what this data tells you is that people are increasingly worried about losing their current job while simultaneously being worried that they might not be able to find a new one, which is not a great feeling about the current economy. And that goes back to the spending data that I talked about a couple of days ago, guys. When you look at the spending data, spending has essentially been flat in February. There's no increase when you account for inflation, and most of the spending was going towards items that people were worried that the tariffs are going to spike prices on, like appliances and brand new cars. Those are expensive items, and only a small amount of people can even afford those things anyhow. We have credit card delinquencies that are creeping up right now. It was up about 0.5% in the fourth quarter from the prior quarter and the prior year. And a lot of the delinquencies are with things like auto loans and credit cards right now, but also the mortgage delinquencies are spiking. Take a look at this chart. Mortgage delinquencies right now, according to Freddie Mac, are actually higher than they were during the 2008 housing market crash. And in the meantime, people keep racking up more and more debt. Mortgage debt continues to climb. Credit card debt continues to climb at a very alarming pace. So it's like, where does this end? Well, it ends with places going out of business or severely cutting back on workers, which is why I wanted to make this video to begin with. In fact, there are some businesses out there that still haven't been able to properly recover from the pandemic. Most notably restaurants. Restaurants are one of those businesses that took out a lot of loans in order to continue operating, especially after the shutdowns. You know, restaurants were basically only allowed to do takeout for a long time, so they lost a lot of their business. And even once they were able to reopen in places, they still lost a lot of business because people were afraid to go out to eat. Well, now a lot of these businesses that took out loans during the pandemic are on the hook for paying them back. And if anybody knows about those loans, these were 30-year loans, basically a mortgage that was given from the Small Business Administration to these businesses. And you either have 30 years to pay it back or you can pay it back early. They talked to a guy who owned 10 restaurants in Charleston, South Carolina, and Nashville, Tennessee. And he ended up closing a bunch of these restaurants. But before he did, he ended up taking out the EIDL loans to try to keep them open. And he says right now he has $4,000 to $5,000 per month of payments that I make on loans that were taken out during the pandemic to save restaurants that couldn't be saved. So he's basically paying off loans for businesses that have already went under. Imagine being in that situation right now. That's kind of worst case scenario for this economy. Now, a guy that owned 10 restaurants probably still doing okay, but to have that burden each month and have those loans for businesses that aren't even open anymore really sucks. And it was easy to make these payments in 2021 and 2022 when all that inflation and all of that cash was injected into the economy and it looked like everything was going to be fine, right? Until everybody got slapped with reality in 2023 when inflation really started to pull ahead and stretch people's budget, and has been for the last couple of years now. And that's changed everything with restaurants. Now, a lot of people aren't going out as much as they were before in order to save money because everything costs significantly more than it did just a couple of years ago. And some restaurant owners are actually still waiting on cash from the federal government that owes them money for keeping staff employed during the lockdown. And I'm surprised that they haven't gotten paid because they were just kind of giving this money out like helicopter money. So the fact that people still haven't gotten that money is kind of insane. But the worst part is a lot of these business owners, had to go through a pretty horrific time and just barely scrape by to stay open during the pandemic. And now that all that's over with, they're still scraping by and just barely surviving and in questioning, is this really worth it? Should I keep this place open or let's move on? And let's be real, with any job or business or whatever it is that you're doing, just surviving never feels good. And if that's all you're doing, there's a strong motivator there to kind of move on and try something else and leave that behind. Because there's no sense doing something that you're just surviving unless you have very strong prospects in the future to think that you're going to be able to really improve and increase that business, then fine. But if things have been looking bleak for the last few years and future prospects don't look much better, it's probably time to get out. How about this, guys? Buying a house right now requires 50% more income than it did 5 years ago. 5 years ago, if you wanted to buy a house, you only had to make $78,000 a year. Fast forward to 2025, you need to make $117,000 a year. And this is according to a brand new study from Bankrate. That's a 50% increase in 5 years, and wages during these last 5 years have only gone up 27%. So somebody please tell me how that maths out. And this is the main reason here why when so many people think that, sales are going to recover in the housing market as soon as interest rates come down, the data behind that doesn't support it, guys, because people have not made the extra amount of income that's needed in a lot of cases to be able to buy a home. Yes, mortgage rates are a piece of the puzzle, and if they come down, it will make buying a home more affordable and more accessible to people, but probably not enough to get most people off the sidelines at today's prices. And this is in a lot of cases why we're already starting to see prices fall in many areas across the country because, people are facing lower incomes and higher prices for everything. People are facing homeowners insurance increases that are pretty egregious in many cases. In fact, home insurance right now is increasing faster than inflation. And the typical homeowners insurance policy in 2024 was $3,300 a month. Just from 2021 to 2024, insurance costs increased an average of 24%, which amounts to about $21 billion in price hikes in homeowners insurance, nearly double the rate of inflation. Although probably it's actually under inflation when you look at how much inflation really was during this time frame, let's be real. But of course, all we have to go by here are the official figures, which don't really mean much. So per homeowner, that shakes out to about a $648 increase in annual premiums over that 3-year period. And of course, many other people have seen their premiums skyrocket far beyond $648 in the last 3 years. And pretty much everybody throughout the US has been affected by this in some way by now, because 95% of zip codes in the United States have seen insurance premiums rise over the past 3 years. Here's a list of the places that got hit the hardest. I'm walking through ground zero right now. Miami, a typical homeowners insurance policy is costing you $15,000 a year, guys. New Orleans, it's $10,500 a year. Tampa, Florida, people are paying over $7,000 a year. Oklahoma City, people are paying $6,500 a year. Houston, Texas is $6,300 a year. Orlando, Florida is $6,000 a year. Jacksonville is $5,200 a year. And Louisville, Kentucky, the most surprising one on this list, is at $5,100 a year. Then you can see a list of additional cities here that saw the largest percentage of increase in their premiums. You got Salt Lake City, New Orleans, Jacksonville, Phoenix, Chicago, Pittsburgh. We're talking 62 to 42% increases in the span of just 3 years. Well, going back to what we talked about earlier with the wage info, people only seen their wages go up about 27% over the past 5 years, guys. So how are people keeping up with these expenses? Well, in many cases, they're not. They are selling their house. That's why so many homes are for sale now. The amount of homeowners that have regret regarding their purchase is pretty much at all-time highs right now. And think about this. If you're a buyer out there looking to buy a home, you're already facing sky-high prices. You're already facing higher than usual interest rates, at least what people have been used to over the past 20 years. And then you have to be faced with the highest property taxes ever. And on top of that, you're looking at insurance premiums that have gone up in over 60% in some cases. No, people are just saying, no, 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 I'm not buying that, or I can't buy it. And if I am going to buy it, the price is going to have to come down substantially. In fact, the property tax and homeowners insurance situation has gotten so bad that about a quarter of homeowners throughout the entire country are now paying more for their taxes and insurance each month than they are for their mortgage. I think that's actually my case now with my HOA fees. When you combine all the special assessments with the HOA fees, I think that's more than our mortgage now. So it's no wonder that 6 million people across the country are skipping homeowners insurance altogether right now. And in a lot of cases, it's lower income people, but are fortunate enough to have a property that's paid off and are just kind of taking chances. Other times it's people that are well off financially and know they can afford to self-insure, and they already know the games and tricks that the insurance companies play not to pay you. And if you make a claim, your rates are going to skyrocket anyhow. So let's try to do this ourselves. One of the best pieces of advice that was given to me regarding homeowners insurance, if you really want to keep your premiums down, which only works though if you have no mortgage, is you basically have no wind coverage on your house, and you just have the basic liability protection, and then you get a flood insurance policy, especially if you're here in Florida, but really anywhere in the country can experience flooding, guys. But that can be a great way to still keep yourself protected in a lot of ways and still be insured for pretty much everything except for the wind damage. And the wind deductibles are usually so high anyways that by the time you pay it, you know, most of the cost is going to be on you. And then by making that claim, your insurance premium is going to go up. So a lot of times it's not even worth having anymore. So let me know what you guys are seeing out there. Are you seeing friends being laid off, family members being laid off? Are you seeing any of these warning signs at work that you might be laid off? Let us all know in the comments down below. And if you enjoyed this video, make sure that you are subscribed to the channel. And if you don't want to wait for my next video to come out, check out this one on the screen right over here, and I'll see you in the next one.